So what is ethical investing? Ethical investing is where people choose where they want their money to go investments in a way that the criteria of the companies in those specific funds meet a certain set of criteria that they have that they believe aligns to their personal values. Ethical investing is also known as socially responsible investing, sometimes just called SRI. And these strategies aim to generate financial returns. You want to get your money working for you, whilst also having a positive impact on society and the environment. So ethical investing and choosing ethically SRI or ethical investment funds can allow us to feel that we are literally putting our money where our mouth is, that we're putting money behind the things that matter. And also in the inverse can feel like we're avoiding giving money and rewarding the bad guys or companies that are engaging in practices that we believe are harmful or unethical or don't align to our personal values. And so there are 4 primary categories of ethical investing, and they each have a different focus and set of criteria. And this is very important to understand because a lot of people just go, oh, ethical investing, tell me about an SRI fund or an ethical fund. And go, good, careful. There's a very broad category. And so you need to get very clear, what are you specifically talking about when you are talking about wanting to invest in a way that aligns to your values? So these 4 primary categories, the first is socially responsible investment funds. And generally, these are ones where the fund aims to avoid controversial areas such as gambling, alcohol, tobacco, often called the sins, firearms, can also be fossil fuels. So here, it's more about an investor's moral values, but that are given the critical importance in their investment selection criteria. I don't like smokers, or drinking is bad, or gambling is bad. And so these funds focus on excluding companies that are involved in those sectors. The next criteria are environmental, social, and governance funds. So these are called ESG funds. Now, unlike the social responsibility funds, these criteria is more about how the environmental, social, and governance risks and opportunities can cause a material impact on a company's performance. So ESG funds invest in companies that prioritize sustainability. They prioritize inclusivity, and in their employment categories, they look at governance and look at environmental responsibility while still maintaining viability and profitability and returns. And so we got SRI, environmental, social, and governance funds. Then you have impact funds. So impact funds place an equal importance on fund performance, so the return on that money, and hence they aggressively look at creating ethical change supporting companies that provide certain products or services whilst being competitive. So they look at what are the sectors that currently have got high returns. That could be renewable energy, it could be battery technology, and so on. And so they are suitable for investors that are wanting social impact and change, but also wanting that good return. So impact funds can have a range of different things in it. And this is so really important because, it's looking for, these are, let's say, the trendy or things that are deemed socially and environmentally or sustainability, but it will choose ones that are primary about the return. And then the 4th category that broadly falls into these is faith-based funds. So you get Sharia type funds, or funds that follow a specific religious set of values and beliefs, and they strictly exclude investments that don't fit those criteria. So you can get kosher type funds, you can get Sharia funds, which are Muslim Islamic impact funds. And they are designed then for investors who want to align those investments with their faith and those values. And so, again, it's very interesting because you might get, the Christian-based fund. Well, what does that mean? Christian values. Is that anti-abortion? What are the criteria? Do they exclude pharmaceutical companies that produce abortion pills or give women access to choice. So it becomes a very interesting and murky field. So when we look at the pros and cons of ethical investing, I think it's not just as simple, hey, I'm just going to direct my money at things that do good in the world. And it really has sets of pros and cons and advantages and disadvantages for your own investing strategy, the returns you get, and challenging the very thing that we would like to believe. So, what are the advantages of ethical investing? The obvious ones, it gives you an opportunity to align your investment with your personal values, to put your money where your mouth is. You can support companies with promoting ethical practices or practices that align to things that are important to you: conservation, environmental protection, sustainability, social inclusivity, governance, representation on boards, gender equality, and so on. And often investors will feel really good. There's a feel-good factor with ethical investing where, hey, I'm doing something good. And that emotional benefit is an important one as part of us experiencing our wealthy life. But it's a very interesting one because, a bit like giving, a lot of people love the feel-good aspect of contribution, of giving, of charity. But most of the kind of charitable things where, people will publish on their social media or put it in their thing or, build yet another school in Africa are actually not great impact things that really make a difference. Often the things that have the greatest impact aren't that sexy, and we often wouldn't choose to do them from an emotional or a feel-good factor. It doesn't mean that feel-good isn't important, but we've got to have that complexity and that nuance to just understand and differentiate from that. And also, as more people are investing in ethical funds, there's more money around available to, especially when we're going to get to the things we call the initial public offerings, to really start making a turn. And if people, and a bit like the organic label, it can be something that companies can aspire to get a label of for an ESG or a social responsibility fund in that, and promote more awareness, and it becomes cooler to be in that. And so, there's a hope that it will kind of get more companies to align their business practices and their operations to different ethical practices. Now, to the disadvantages of it, from a pure financial and investing aspect, because they are not active, they are actively managed funds, because you've got to select specific criteria. It's not just an index that gets tracked. They generally have higher ongoing charges, and so your return can get impacted on that. There are also fewer investment options in that selection, so you're automatically narrowing down the options of investments that you can have. And it's like more complexity in selecting your funds than, say, a straight, simple index tracker investment. They're more complex to manage. So there's a lot more research that the fund management house has to do. And it's also very easy for them to get that wrong in terms of those criteria of, well, are those companies actually doing what they say, or do they just take a company brochure and look at what the company is saying? And so you might not get the returns, the optimal returns you could get in terms of actually achieving your financial freedom. And often you're sacrificing some level of financial gain for the feel good and the ethical tick that you're wanting to have. But I guess coming back to an advantage, if that means you actually do get investing, then that is a good thing than sitting on a sideline concerned about what your money is or isn't doing. So what are some of the issues with ethical investing that you need to be aware of? And as it's gaining popularity, and there's a lot of confusion, some obstacles to really going, hey, it does what it says on the tin. And I do use the analogy with the emergence of your organic farming and your free range and environmentally and sustainable farming methods, where one of the things you have is huge industry label confusion. Now, there was a survey by a company, and they showed that the ESG investing funds use labels that most investors don't understand. So they use, again, the 3-letter acronyms, the labeling, and it just sounds good. So a person says, oh, well, I'm an ethical investor. I invest in ethical funds. But I say, well, do you actually know what your fund's invested in? What does that label on that fund actually mean? And so, we've already covered the definitions such as ethical, sustainable, social responsibility investing, faith-based investing, sustainability, but can be a lot of overlap. And, the labels you can get is, ethical investing. It can be applying negative or positive ethical or value-based screens to sift investments. Well, what does that really mean? Maybe that's what the fund manager put in there. Do we know what that actually means? Environmental, social, and governance, those ESG investing. A label, I looked at one of them, says, strategies that take into account environmental, social, and governance-related risks and opportunities, often to help reduce risk. But it's the company's risk, or not the environmental risk. And so we could say, there's a ESG fund, but those criteria, the governance and environmental and sustainability risks, are the risks that companies are managing for their sustainability, not for the environment's sustainability. So there can be these confusions in these criteria. Impact investing, investing in a way that delivers measurable social and societal effects and benefits, as well as financial returns. Well, what is being measured in terms of that effect? Another one is called dark green investing. This is where funds strictly screen the companies that they invest in to avoid companies that don't invest in environmental or look at environmental sustainability. So you can have this dark green, light green. So dark green are removing companies that are seen to do environmental damage. So maybe fracking companies. And light green is including companies that do environmental good, or seem to include companies that enhance the environment. So that could be your alternative energy or sustainable wind farming and so on. But there's currently no standardization on those labels. So they can vary by fund manager to fund manager. And often it's just a branding and a marketing copy piece. And if you look in the automobile industry, you could argue that this is a negative impact industry, since most cars still run on fossil fuels and contribute to pollution. However, you've got now companies like Tesla and others producing your electric vehicles. So does that contribute to an ethical investing company? Because now we're looking at battery and electrical operations. But what is being used to produce the electricity being run by those vehicles? Is that still fossil fuels? Is it gas? Is it coal stations used to charge those vehicles? They might reduce the emissions, but what's the impact there? So the challenge is, it can really, just for us as individuals, really wanting to make sure that our impact on how we consume leaves the world a better place, or at least doesn't do lots of damage. And so just like it's so difficult for us individually to balance out the recycling, the what we use, how we consume, when we're choosing these funds, it gets even more complex. And then you can take, that looks still in that industry, take Audi, and they manufacture both electric and fossil fuel powered cars. And so you could argue, well, Audi should be included in a light green portfolio for its electric cars, but it should be excluded from an ethical portfolio because of its fossil fuel powered cars. So where does it sit? Then there's also huge unreliability of data. And the vagueness of data also makes for difficulty in truly understanding markets' performance. And since these interchanging labels and standards can lead to varying research, you might have one company included in one company's fund and not in another. And often they're just taking it from the company's data as well. So it all becomes just words. And you need to make sure that those words align to what those words mean for you. So, it's really well known that industries like clean energy are growing and carrying greater importance, but they're still relatively young. So their fullest potential is still yet to be realized. So it's difficult to estimate their economic performance or their return on your money invested. So what is their actual financial performance? And also, what is their longer term sustainability and impact? Then there's a thing called greenwashing, and this is a bit in the organic labeling side, where a common issue in these kind of funds is something called greenwashing, where there's misrepresentation or misrepresenting an investment to appear more environmentally friendly, sustainable than it is. So you think if we go and buy eggs, you might say farm fresh eggs. Well, it doesn't mean that there's not just a whole lot of battery chickens, that battery happens to be on a farm. It doesn't mean they're free range. Are they, grain fed? Does that mean the chickens actually get to go and peck the ground or not? And so you can have these vague labels. And so you can get environmentally conscious. Well, what does that mean? And so often there's just a huge murkiness in this area. So as the markets realize that the public is becoming increasingly more socially conscious, these green labels suddenly are appearing on everything. And critics have called sustainable investing a real marketing ploy and a scam for this exact reason, and noting that companies are merely trying to capitalize on this trend, and fund houses are. And greenwashing can call companies to be incorrectly included in these ESG funds and contribute to the very problem of unreliable industry data. However, we've be careful not to throw the baby out with the bathwater. It is a new emerging area. There's confusion with the labeling. There's no consistency yet. But I think the general commitment towards sustainability, towards environmental consciousness is better than nothing. And ultimately, it's up to each of us to decide what is going to help us actually, one, take responsibility for our own financial well-being, make sure we don't become a burden on a state or somebody else. And then how we do it is we look at those fund fact sheets and sit and be prepared to do some of your own research. And this is the thing. If you want to go down the ethical investing route, be prepared to and be ready to do some deeper research. You can't just take the label at face value. And also be prepared to sit with the complex nuance that is in so many areas. It's in the conservation field, in the anti-poaching area, in environmental ethics. They're complicated. And, we've also got to look at certain industries that are they making changes, and what is the impact of not having those in place? In-depth research is a key to reducing the harmful impacts of greenwashing in companies. And a little bit of digging, you can make your own informed decisions about what ones truly fit for you. And so many companies are calling, and parties are calling for more explicit guidelines and standardization in these labelings. But I think what first and foremost you can do is make sure that if you're going to choose an ethical fund, open it up, look at the fund fact sheet, see what companies they have in there, and do some of your own research and see if they align to your values. Now, we'll go into a little deeper how to select them, where you can find them, but I just want to go deeper into, well, does ethical investing actually work? So besides the feel-good factor and feeling like we're making a stand for our values and the things that are important to us, does it actually have an impact on companies? So, one of the key aims of ethical investing is to avoid investing in companies that we believe are operating or causing damage or in a way that don't align to the things that we believe are important. Be they, as I say, governance, could be gender inclusivity, it can be environmental impact, it can be sustainability, it could be social, moral, religious values, whatever they are. So, however, one thing we absolutely have to understand, boycotting the evil companies by not investing in it does not mean that money is not going to go to that company. So we've got to really understand how the stock market works. When you are buying a share in a company via a fund or directly, you are buying it from another seller. It's called a secondary market. So there's the stock exchange, and shares in these companies are bought and sold. So the money is moving between investors. Could be individual investors, institutional investors like big pension funds, but it's moving between the investors. When a company first gets that money is when they do the initial public offering, the IPO, is when they issue those shares to the market, and the first time those shares are bought, that is when the company gets the money. So you withholding buying that share is not preventing the company having got its money. The first time it listed, it got that. Now, of course, companies benefit from the share price. And they'll often own a lot of shares. Their directors will own shares in their own companies. So there is an impact on share price. Now, the thing is, by you not buying those shares in, say, an index tracker fund, the small amount of money that's going in there, your regular investing going into that tracker fund, and then the percentage of that fund that goes into that company, it is such a micro amount. So firstly, it's not going to affect the company. It might affect the share price if fewer people go into it. So the liquidity and the demand for those shares reduce. But the challenge with that is, what happens is the share price can then reduce, and it just makes the return on those shares, especially the dividends, the growth, more appealing for other people who aren't producing those same criteria. So the small pool of ethical companies that are available for these funds, it gets more competition for that, so that it falsely pushes up those price of the demand on those companies. So it's the share price that gets pushed up, not the company's performance. And then other investors get a better return on the shares where there's lower demand for them. So withholding your money in investing from those companies does not punish those evil companies. But it is also then important to understand there's the complexity here, because besides also you're not punishing it by that company by withholding, and you've got these huge institutional investors and industries as a whole, which are far greater than the impact of your amount of money. We also understand that ethical investing needs to fulfill certain criteria, and they're very high standards to achieve. And you've also got to say, well, your criteria over what scale? What is the ecosystem of impact you're looking for? For example, that's okay, great. Solar panels are fantastic, alternative to fossil fuel. Now, the very production of solar panels, in many cases, that company might be polluting the environment in the manufacturing process. And so does that become self-defeating? Or wind farms, are they taking up huge swathes of land that could otherwise be used? Now, I'm not taking a case for one thing or another, but we've got to understand there are complex sites in terms of how companies actually operate. So we might say, we're looking at, well, are we identifying business opportunities that have a result in a positive impact on the planet for humans and animals and all sentient beings and the environment and the sustainability? So there is this additionality that needs to be considered in the whole chain and the path and a timeline. This is often called like whole cost analysis. What's the whole impact of those choices? But it's complex and it's really difficult to do. So for example, let's take an example like British American tobacco. Tobacco, sin tax, bad. So a lot of people will go automatically, tobacco must be out of their ethical investing. But the likes of British American tobacco and some of the other tobacco industries actually provide extraordinary support for micro farmers in very marginalized and poverty-stricken areas to actually have a viable business in areas where tobacco is one of the few crops that will grow. It's often environmentally sustainable in those areas. And British American Tobacco has done extraordinary work for women farmers, where they actually own their farm, giving them secured supply chain. So we can sometimes then end up with these conflicting sets of values and go, well, how do we know? So firstly, I'm just saying, this is a complex area. And if we just want that feel good, great. But if we really want to make a difference, we've got to be prepared to do some research and also sit with some of these complex questions for ourselves. What are we actually trying to achieve? And sometimes the thing that we really want to achieve, like we want to improve the environmental impact in this area, a lot of research has shown that how we consume and where we use our dollar, our euro, our pound, our rand directly has a far bigger impact than this disconnected, indirect impact through the way where our money goes through our investments. So what we choose to consume, how we buy. So if you're concerned about the environment and the impact that palm oil is having on orangutans and the environment and the huge swathes of extraordinary pristine forest being destroyed, you're going to have a far bigger impact by really doing conscious consumption and trying your damnedest to avoid products with palm oil, which is damn hard, but hey, at least we can try, than saying, hey, I'm not going to go invest in an index tracker where there is a company in there that has a stake of some sorts in palm oil farming. But again, sometimes it can just feel easier to say, I'm an ethical investor and I only invest in ethical funds. So now we've covered the complexity of it. So, okay, you want to do some ethical investing. First thing, get really clear on your criteria for you. What is it for you? Is it social inclusivity? Is it corporate governance? Is it environmental impact? Is it sustainability? What? Because that is important. Is it faith-based investing? Because that's going to be your criteria. Once you've got those criteria, you can then start going onto screeners and start looking at which are the funds that align with that. So understand the difference between the labels, the social responsible investing, the environmental governance and sustainability investing, the dark green, the light green. Now you can start pulling some, and then you can look at that. Now you want to look at investment strategies, and you want to consider the investment strategy of the fund specifically. So you need to go through those screeners, pull out an assortment that are available in your country, say available on your investment platform, and say, okay, each of them, open the prospectus, open the fund fact sheet and go, what is the strategy that fund's saying it's doing? What is its label? What are they saying they're prioritizing? Are they prioritizing inclusivity at the corporate level and board level of a company? Are they about governance in the company, or are they about social and environmental impact? And so look at those criteria. Is it about clean energy? Is it about renewable and sustainable technology? Look at those criteria and go, oh, yes, that's what I'm looking for. Then absolutely look at the fees and expenses. Look at the ongoing charges. You still want to keep your charges down, because remember, it's one of the things we can control, our costs of investing. Because if you're going to end up getting significantly lower returns on your investing as a result of your ethical investing stance, and so your wealth pot reduces, you're going to have less money to direct to the things that are important to you. So I have taken the stance that I'm aware of the complexity of this. I'm also aware that there are certain companies in some of the index trackers that I hold that don't align with my values at all. And I've sat with the complexity of a very difficult decision and said, I still choose to do index tracker investing as the bulk of my investing, because I know that is the way that is going to get me the greatest return. And I accept that there's a small trickle that it might keep some of the share prices of some of those companies up, my small contribution to that. But this way, I have a far bigger amount of money that I can do direct impact contribution to. I contribute directly to conservation. I fund units that clear invading alien species from the land in certain areas to make sure that the environment is sustained and these alien plant species don't destroy the land for the animals. I support anti-poaching units. I try in my own consumption to avoid products that and companies that have the impacts that I believe they have. I look at how can I recycle, those sort of things, because the environmental aspect and sustainability is important to me. I look at how I consume energy. And I do have alternative energy sources in my homes and different aspects there. Far from perfect, but I've sat and said, for me, it's more important that I have resources that I can do direct contribution to than an indirect impact that I know from research is significantly less. So consider those fees. Then you want to look at the track record of the fund house, How much research do they do? Do they actually just take the greenwashing of the labels from the companies that they've taken, or do they actually go and look into those companies? You want to look at transparency and disclosure. So again, you must be able to see the fund fact sheet, exactly what their holdings are. You don't just want a wishy-washy label and you can't see what individual companies that company is holding. And then you want to look at, for regular updates, you're going to have to be a more active investor in ethical investing to truly be able to say it is having the impact that you want it to have. And then, fund screening platforms. So there's some great ones around. So in Europe, there is one called Ethical Screening. There's another one called IRIS, EIRIS. Another one, VIGEO, IRIS, and they are popular platforms where you can do screening. You can also go on to the likes of Just ETF and choose ethical and screen for ESG or SRI funds. And again, good old Google. You can say, what are the top ethical investing funds available for investments in Europe, in UK, in Australia, in Canada, in the US. In Australia, there is the Responsible Investment Association of Australia, the RIAA, and they have a database which provides information on ethical investing. In the US, you've got the Impact Assets 50 database, and that features funds that focus on impact investing, specifically available for in the States. In the UK, there's Ethical Investment Research Services. It's the EIRIS, again, similar to Europe, and that they do these searches. And there's also a platform called Good Money, where they look at the different funds available. Now, in South Africa, it's a much smaller market. You've got far less choice. But the JSE, the Johannesburg Stock Exchange, does have a socially responsible investment index, and that tracks companies that meet a certain set of criteria. But again, go and understand what those criteria are. So just in conclusion, I think ethical investing is great. I think us believing we can put our money, our resources, our time, our energy behind the things that matter to us is so important in living a wealthy life, that we feel aligned to how we spend our key time, energy, money, resources, that they align behind our values and beliefs. And we also need to sit in the humility of being human and understand the complexity of these choices and decisions. And so when we can also come know that the feel-good factor is an important thing. It's not nothing. We can go, oh, well, it's just a feel-good factor and we can belittle it, but it's not nothing. If that means we actually get better with our money, we invest, we do a bit more research, we go in, great. I think just be careful of just blindly ticking off something because it's the trendy, cool, in thing to do. It's woke. We've got to be prepared to do the more complex research and go in, and also understand the trade-off that you're potentially doing with your returns. And I think that just the whole exercise of understanding this really goes, well, what's important to me? Great. Well, how am I going to achieve that? And so on top of your ethical investing in terms of how you choose your funds, to also say, this is really important to me. And this is one of the reasons I choose to master my money stuff, knowing that money is a magnifier, that when I have more, I can direct it to these areas directly. And that is going to have a far more magnified impact than both how I withhold and what I give my money to, than the indirect lever through my investing.